Right. Hi, everyone. Thanks for joining me in this segment of the Singapore Trading Festival. I'm Philip Teo, a partner trading coach with SGX Academy and also the CEO of TraderWave.com, a company that I founded a few years back to educate and help independent retail traders become the best traders they can possibly become. I'm very honored to be invited by the SGX team to host this live virtual fireside chat today with Jack Schwager. Jack is the founding partner and chief research officer of Fireside, a platform designed to discover trading talent globally and connect them with sources of investment capital. More importantly, Jack is best known for his Market Wizards book series that has sold more than 2 million copies to date. Titles include Market Wizards, Stock Market Wizards, New Market Wizards, Hedge Fund Market Wizards, and most recently, Unknown Market Wizards, the best traders you have never heard of. Now, this is a book that features interviews with individual traders who are trading their own accounts, just like probably most of you are, and have achieved performance records that rival or even surpass many of the best professional fund managers out there. Now, in this short 30 minutes chat, I will be interviewing the interviewer to get him to share with you the key insights that he has gotten from studying these top independent traders and how you might be able to make use of these lessons to improve your own trading performance. Now, with this short intro, it's my honor to welcome one of our keynote speakers for this trading festival, Jack Schwager. Hey, Jack, welcome to Singapore Trading Festival and taking time off your busy schedule to join me in this fireside chat. Now, as time is short, I'll simply get straight to the point with today's topic of discussion, which is Unknown Market Wizards, the new book that you have just published a few months back, shall we?
Sure, I'm glad to go.
All right, great. So just for a start, how did the idea of actually publishing this book come about? How did it occur to you that you want to publish a book that features and focuses on unknown independent traders?
Sure, the main influence was actually through Fireside, the company you mentioned, which has a trader platform and looks to find trading talent worldwide. So when we were originally designing the website, my partner, who was the CEO, Emmanuel Bellari, thought it would be a good idea to maybe, he gave me the idea of doing a book just focused on unknown market wizards and put it on the site that the people join, they have a chance of being in the next Market Wizards book. And as it turned out, indeed, a number of the traders in Unknown Market Wizards were found through Fireside.
I see. And I think that this will turn out to be even a better idea because I'm sure the audience pool will now be much more increased since we have so many independent traders out there who will be looking to be inspired by this new book that you have. So I'm sure you had plenty of potential candidates to feature in this book before you decided who to pick. Now, what were the key criteria that these independents have to satisfy before you decide to actually choose and even feature them in this book?
Sure. So the first filter was length of track record. So with there's one exception, which I can explain, but basically I was looking for track records of at least 10 years. Some of the traders in this book have track records of 20 years plus. So that was the first thing. It had to be a lengthy track record because lots of people can trade for 2 years and do very well. It doesn't prove anything. And then the next criteria, or kind of simultaneously, was to have exceptional return risk or kind of astounding cumulative returns, one of those two. So some of the people in this book have literally the best return risk numbers I've ever seen in my life in any book, even better than the famous, Market Wizards in the original first two books. And there's one trade in this book has a cumulative return which is literally unbelievable. So those were the key factors for inclusion.
I see. So what would be one of these 11 traders that you interview in this book that you think would be considered as the top trader within this book itself, and what would be the main reasons for that?
Well, I mean, there's a couple. It's hard to say which one specifically, but one who certainly would get mentioned is Jeff Newman, who started trading right out of college with what I thought was the ridiculous assumption that he's going to make $1 million in his first year. His account was like $3,000, and he didn't make it in the first year, but I think it was like 15 months that he got to $1 million. And in the next, I think he started about the next 16 years or so, after which I interviewed him, that he had made about cumulatively about 50 million. And unbelievably, I've kept in touch in the year since the interview, or year plus, and he's literally going over 200 million out of an initial account of $3,000. So, you can't beat that. It's just totally astounding. There's another trader who has a Sortino ratio of, I think it was like 15 or 20, some ridiculous number. You don't normally see Sortino ratios higher than 3 or 4, So, he was like 5 times better than what would be considered an excellent trader. So there were a number of people in the book and that was Ahmed Sal. There were a number of the traders had average annual returns in excess of 100% for periods of over 10 years.
I see. And just to be sure about that, because I'm very sure many of the audiences must be wondering in their mind, does Jack actually vetted through their actual real trading statements and account, or is it just based on what they say they were able to share a little bit more about that?
If you told me these numbers of the people in the book, I wouldn't believe them, right? So now, if it's on Fundseeder, by the way, there the accounts are verified and through the broker. So that's verification there. If it's outside of Fundseeder, then I basically have their statements, sent, and so I can match up the statements to the performance. Actually, I used the statements to calculate the performance. So I put these together because I would not believe these records if I didn't see proof. I still don't. I don't believe them. I do believe them, but they're hard to believe even with the statements, but because they're so crazy.
I see. I'm sure many of our audiences today must have always been wondering to themselves if they are ever able to become a profitable, and maybe not as profitable as those traders that you have featured in the book, but maybe at least being profitable to a certain extent. Now, do you personally notice any common traits among these 11 traders that could potentially provide our audiences some insights and guidelines on whether they might have the similar traits to become similarly as good as well?
Sure, there are a number of them, and it's a good point you make because only a tiny percentage of people are going to be market wizards, but there's still lots of room for people to be profitable traders, and that's a much larger audience, and that's really who I'm speaking to. Actually, I've had many hedge fund managers tell me they read the books and that's what inspired. So yeah, some of the people who read my books do end up being in market. In fact, probably almost all the people in this book had read the original books. So so some of them will be, but for most of the audience, as you say, so what's relevant? What do these traders then say that's relevant? Well, first of all, is understand, and this people who've heard me before have heard me say this before, but risk management is more important than your trading methodology. So of course you need a trading methodology that has an edge, and you need the discipline to apply it correctly. Okay, but even with that, you just must have risk management as part of it. Otherwise, it's just a matter of time before the account blows up. So there's one trader in the book who maybe you used a similar method but didn't have risk management, blew up, but once he got risk management, he became very successful. So that's one very critical thing. Another thing is the topic of emotions and being aware of your emotions. There are a number of traders keep logs of when they do trades, what the trade is, not only the reasons for the trade, but what their emotional state was. One trader even keeps a spreadsheet with different columns for different types of emotions and factors. Like, I'll give you an example. One column was sugar trades. I said, what's sugar trades? Well, a sugar trade is a trade that isn't planned, but you just kind of take it because you want to do something. So if he ever does that, he'll check that. And at the end of the week, he goes through, looks at the spreadsheet, looks at all the columns, sees if any column has a number of checks, and he knows that's where he has to focus on. That's where he has to improve. So, that ability to be aware of emotions. Then the other thing is focus and mindset. this is something that came up in a number of interviews where the traders will mentally prepare, get almost sometimes meditate, sometimes just get into a state where they're calm and focused. So that's what you want to be. You don't want to be emotional. You don't want to be sitting there, oh, this is rallying, I'll buy it. This is going down, I'll sell it. You don't want to do that. You want to be very cool, very focused, and very calm, and have a plan that you're following, and not be influenced by the market gyrations in that sense.
I see. All right, so I want to make this session really relevant to our audiences today, right? So, and most of our audiences are actually regular part-time independent retail traders and investors. And if you were to choose one of the traders that were featured in this book, who will you actually consider to be one that is the most relatable to our audiences today based on the kind of profile of audiences that we have? And what do you think are the main things the audience can attempt to emulate this particular trader to improve their own trading performance?
Okay, so I would say it depends. If, let's say, just more general, I'll give you two traders. So one is Jeff Newman, who I mentioned before, the one who made spectacular cumulative returns. Now, what he does, a number of things, he's very aware of trying to find early trends. Early, by not trends, I don't mean price trends. I mean things that are going to happen that are new. Like, for example, when 3D printing was starting, he got every 3D printer, he researched every company, he knew everything about 3D printers. And so then he would use technical analysis to get in. He'd be looking for signs of interest in a stock and its first breakout. And he'd play very close stops. If he got stopped out, still believed he'd go long again. And he would catch the early trends of a new idea, of a new thing. And a lot of times these companies went all the way up and then he went all the way down. But he would be getting out when the long-term trend broke. Or when he would get out when CNBC started having CEOs from 3D printing companies on the program. That's when he'd be looking to get out. So once the idea is disseminated, that's where he gets out. So he's using fundamentals in trying to spot, very much like Peter Lynch in his book, talked about, right? So, and he combines it with technical analysis. So that's a good example because people can look in their everyday life, they can read, they can spot things and think that this is early. For example, right now, this is no longer early, but here's a perfect example. And this is an area where he invested in heavily early on, but all types of green stocks, batteries, EVs, everything to do with green energy, because he saw that this was going to be a big trend. And so that's where he looked to get in early. So he kind of became expert on all the battery companies, all the electric vehicle companies. And that was his main, and inputs that the metals and the materials like lithium particularly that needs to go into, like the batteries or whatever. So that's a perfect example. And this is something that literally people could do they can just be observant in their everyday life for the ideas.
I see. And you mentioned that actually the timing part is also where many of these top traders actually outperform the index or many fund managers out there, right? So is
Right.
timing something that you think is really crucial in terms of maximizing your performance as well?
I'm sorry, what's the question?
Is timing also very crucial in terms of
timing? Yeah, timing is critical. I think, for all these traders, timing is critical. And I mentioned Amit Sal, who's like this very focused trader and is credible return risk. He focuses on trading events like central bank announcements, stuff like that. So it's all about timing. So when there's an event, he's looking for, he knows, he's planned out whatever the central banker says, he knows what he's going to do. And he'll react immediately. So it's very, very much a timing thing. And if the market doesn't behave like he expects, he'll be out very quickly. So it's all about timing. Newman, I talked about these big trends, he still gets in on a breakout, just again, it's a timing thing. somebody like Peter Brandt, who's a pure chart analyst, chart trader, I should say, all his trades are picking a precise point where the trade should work right away. And if it goes down for 2 or 3 days, he's probably, he'll be out, he's out. So timing is probably a factor for every trader that I interviewed.
I see. And so in this current era where I would think, or most of us would think, that the access to information, knowledge, and news is now readily available to anyone out there generally. So do you personally think that this actually levels the playing field somewhat for the regular independent retail traders out there, compared to like those money managers or fund managers who have a lot of resources to all this kind of technology and information?
Yeah, in a way it does. In a way it does because, just everyday traders can access tremendous amount of information for many times no cost or very little cost. Now, true, hedge fund managers will have some extra information. They may get credit card information and stuff like that, which maybe cost-wise is not going to be accessible. But I think on balance, the world is probably more equalized. And one of the things I should mention that was particularly surprising when I did this book, I kind of went into the project thinking, well, yeah, I'm looking for really good traders, but I'm not going to find traders like in the first Market Wizards book, because, those people, we had these giant trends, it was a big time of inflation. You had gold go from like 100 to 1,000. You had sugar go from a couple of cents to 64 cents. You had these giant trends. You also was pre-computer. You weren't competing against, Renaissance and D.E. Shaw and these giant mathematically oriented. And I think it was, and there was no PCs even. So I thought that no way now, if all the computer power and all the PhDs in mathematics and computer science who are working for hedge funds, that the ordinary guy could do anywhere near as well. And I was amazed that some of the traders in this book, in almost any way you want to measure them, are even better than the traders in the original book.
I see. I'm just wondering, would one of the main reasons be because that these individual traders or independent traders, they are generally, because their account size is not that big, they are actually able to actually focus more on those unknown stocks, like the unknown wizards we talked about today, that the big fund managers it's not liquid enough for big managers to actually trade or invest in, but for them, they are able to see and get in even earlier before all these money managers?
Yeah, that's an excellent point. So assets under management, having very low asset management is an advantage, because, like you say, you can go into stocks that would be not liquid enough for a hedge fund, or commodities that are not liquid enough for a big hedge fund. I remember Bruce Kovner saying, I'm really good in analyzing the coffee market, and coffee can have these giant trades, but he says, even if I get a big trend, it's like it's like 1% of my portfolio. It just barely moves it. It's almost not worth it. But for the ordinary guy, that's not necessarily the case, right? And Jeff Newman, I mentioned, actually began with, and even to this day will still trade, although his size is now way larger. But he traded many penny stocks. And he wasn't trading on penny stocks in many cases scams, but he was trying to find situations where there was a real reason for the stock to move, or he saw insider buying or something. He had no inside knowledge, obviously, but he was in a game where most people lose all their money because it's like a pump and dump. He was able actually to make a lot of money, and that was actually in his initial years, most of his trading. So again, to your point, having lower assets is an advantage, not a disadvantage.
I see. All right, so there are many stock, not just traders, but stock investors, those slightly more longer term kind of stock investors amongst us today. Do you think any of the lessons learned from these top traders might be relevant and applicable to these long-term stock investors as well? And what might all these lessons be?
Sure, and you're talking really now was the difference between trading and investment, okay? And so some of the things are relevant, but the most important point I would want to make here, because it's really critical, is that trading and investment are not the same, okay? So a lot of the rules for trading don't apply for investment. So, for example, if you say, I believe gold is a long-term hedge for inflation. You may be right, or you may be wrong, but you say, I have a portfolio and I want to have 10% of my portfolio in gold. Now, that could end up being a good decision or a bad decision. Who knows? But that's your belief. That's what you want is diversification. So then, if that's what you want, if that's a long-term investment based on long-term inflation expectations, then you're not putting in stops. You're not looking at the gyrations. You want to have 10% of gold? You do that, right? Or, like I said, the green stocks, basically. So if you believe that this is a long-term trend and you want to have, this is an investment. Instead of having an index fund, you want to have some of your money in specific, specific green companies, right? And you just want, that's an investment. You're not going to try to go back and forth and whatever. So it's treated differently. That's a buy and hold situation. The key there is you make the decision ahead of time. The problem is many traders do a trade, and when it goes against them, that's when it turns into an investment. No, that's no good. That's just trying to rationalize. An investment is only something you decide ahead of time is a long-term hold, and you only get out when you change your mind, or if it's gone enough that you're satisfied that you've got most of the, that it's no longer an attractive thing to hold. Trading, though, you have an idea that this item, whether it's a commodity or a stock or whatever, is going to go now, and it shouldn't go down a lot. So, and one thing I always advise for trade, which wouldn't apply for investment, is pick your risk point. Say where will you get out, and have us, put a stop in, or if you're well disciplined enough, there's no reason not to put the good to cancel stop, unless you're a very large trader. But otherwise, you put in a good to cancel stop when you enter the trade. So that's the type of thing you do for trade. It wouldn't do it if it's a long-term investment. In fact, it would fight a long-term investment. And I'll give you here one great example from the last Wizards book, not the recent one, Hedge Fund Market Wizards. There's a trader in there, Martin Taylor, who started out as investing in emerging markets, but he diversified also to developed countries. And when I interviewed him, he had one of his worst drawdowns. He was down about 16, 17%. And most of the drawdown was due to one holding, which was his big holding, Apple. But he was so, without going into all the reasons, he was so positive, he was so convinced that this stock was way underpriced. He had no compunction to get out. And 6 months later, the stock had doubled. So if he had a stop on it, he would have gotten stopped out and not got. So but that's an example of a very long-term value-oriented fundamental trader. So it's different.
I see. And I would suppose that, I've personally seen myself, like many of those long-term investments, it will come to a point that some of the long-term stocks might start to go down, and analyzing the trend actually do help you to actually get out before everything becomes obvious. So is that something that you think stock investors might want to consider and take a look at as well, in terms of at least analyzing the major trend? And if the major trend is like breaking down, do at least like take some money off the table and manage your risk from there?
Yeah, and to be honest, I actually, I have a couple of stocks that I kind of am holding as long-term in the green area space that I have, which I think in terms of investment. But what I basically do is, because the markets will have wide whipsaws, and you're absolutely right to point this out. So just from my personal experience, what I do, if these stocks rally, then I'll sell calls, against them. And if it goes up more, if they just react a bit or they go sideways, then I'll make money, I'll get extra money. And if they go up, I have some leeway, because I have the premium. And if they go up more than the premium, then I lose some windfall profits. But it's a much safer way of doing it. And then when they come down, then I might do the opposite. I might sell puts. The idea is, if they don't go down much more, I get the premium. If they do go down much more, selling the put will effectively give me a very low entry price. So in that way, I'm kind of trading back and forth in when the stocks have swings up and swings down, while still always maintaining a long bias.
I see. All right, so time is getting short. I have one final question for you, and I think this could potentially be a more lengthy answer from your side. I understand that at the final conclusion chapter of your book, you actually summarizes the insights that you have gathered from these 11 traders into 46 market wizards lessons. Now, as a conclusion to our fireside chat today, can you maybe like just off your mind pick maybe 3 to 5 of those market wizards lessons that you think will be especially relevant to our audiences today?
Let me just actually, I'm going to pull the chapter and just see what pops up that I want to talk about right away. We talked about a few of them, and like you say, it's 46, so it's a bit hard. But so let me, find a method that's compatible with your personality. That's come up in other books. It comes up here again. So there's lots of examples, but I'll take somebody like Jason Shapiro. He's one of these guys who always has to be on the opposite side. He says if he goes to a cocktail party, if most of the people are liberal, he'll argue a conservative side. If most of the people are conservative, he'll take a liberal side. That's who he is. He always has to be, because his attitude is nothing is 100% black and white. So anyway, that's his attitude. So of course he develops a trading methodology that's contrarian. He's literally, his method is picking tops and bottoms, but he's combined it with risk management so that that it works. So that's an example of kind of your personality being critical in the methodology you pick. You may have to change your methodology. So people start out with one way of doing things, and it may not be right, and you have to be able to change, even within the same methodology. There's one trader, a systematic trader, Marcin Parker, who started with a group of systems. He's a software engineer, and basically that would let him into trading. And he had a group of systems, and he did really well for 7-8 years, whatever. And then all of a sudden, it wasn't working well, and he had the foresight to change his systems. He had a hypothesis of why they stopped working, which was probably correct. Anyway, because he's a software and he's designed all his own software, I asked him, what have those systems done, subsequently? And he shows me this graph, and it's like he can pull up any systems he ever traded. And the graph is like a mountain. It goes straight up when he was trading them, and then when it started breaking down. And since they started breaking down, they've not made money in a single year. So if he had not had the foresight, and this happened multiple times in his career. So even as a systematic trader, he had to change the systems. And so the idea that nothing is absolute, you have to be flexible enough to be able to recognize that this is not working, you have to change. Sometimes certain things work, sometimes they don't. And when they stop working, you have to step back. That's a critical lesson, I think, for anybody.
Sorry, I have to apologize, Mr. Jack Schwager and Mr. Philip Teo. We're really out of time right now, but I'd like to thank you again on behalf of all our viewers and SGX and Investing Note. Thank you for all the wonderful insights. And for those of you who would like to hear more from Philip, he's at traderwave.com. And of course, Mr. Jack Schwager, the best-selling author of the Market Wizard series. Thank you again to the both of you. Ladies and gentlemen, if you would like to go on to the next session, we've got a treat because there are 2 simultaneous sessions happening next. Robin Ho and Keith Chan will be talking about market timing and volatile markets in the English session, while Max Tan in the Mandarin session, 他是会谈2020年转型公司回顾，如何发掘成功的转型股呢？ Please hit the buttons at the top of the page for your preferred sessions or to head on to the schedules. Thank you again to Mr. Jack Schwager and Mr. Philip Teo.